Okay. Welcome back. It's my unpleasant duty to remind you of a couple of things that are coming due. Okay? The first is this Friday is your one-time deal, right? Can you hear me? The first is this Friday is your one-time deal, where if you want to get feedback on your DCF, you can send it to me. It's not for grading, it's optional, you don't have to do it. That said though, please don't, if you've got it done, don't wait till 5 o'clock on Friday, because I'm terrified of what I will find. And make sure you stay with that subject. Remember what it is? Anybody remind me? What do you have to send it? Don't try to be clever and do my imperfect DCF, my not so perfect DCF. You know why I need you to send the same subject, right? Because to find the stuff you've turned in, I'd like to go into one mailbox. I'm not digging through hundreds of emails. And I know at 5 o'clock on Friday, I'm going to get 800 DCFs coming in. That terrifies me. So at least I know where to find them if you say my perfect DCF. Okay? So get it in. If you get it done earlier, send it to me earlier. So I'd much rather stagger it through the week than do it all on Friday, because I'm actually going to be in Poland on Friday, and I have a long flight coming back, but I don't want to be doing DCFs all through the weekend. So if you have already got it done, and you get it done tomorrow, day after, get it done. Whenever you get it done, send it to me by Friday. What's the other thing that's coming up? What's happening a week from today? Quiz. Life moves on, right? So if you're in vacation mode, let it go, right? It's over, right? The break is over. Your next quiz is a week from today, okay? And it'll cover pretty much everything through DCF that we have. And so I'm going to spend today's session filling in the rest of what I started on last class, okay? There's a little pre-class test I was going to do on stories and numbers, but no, I really don't need it, because in a sense, this is all one big storytelling exercise. I know the Wednesday before the break, some of you were not here, some of you were here but not quite here. Some of you thought you were here but not quite here, and I wasn't sure I was here either, because it turned out that the recording of the class around minute 23, something seemed to happen to the audio. I have no idea. I'm wearing the mic, nothing happened, the mic seemed to work, but the audio disappeared, which actually might make the video more watchable, not being able to hear what I'm saying, but it's just slide after slide after slide. So I sent an alternate for those of you who wanted to catch up on that class, an alternate. It's a Google talk that I gave 3 years ago, precisely this topic around building Uber. But you remember I'd built up a story for Uber as an urban car service company that will attract new users into the business with local networking benefits and doing what they were, at least in June of 2014, which includes keeping 20% of the fare and not owning the cars and not hiring the drivers. Then I took that story and passed it through the tests. Remember the 3 tests. Is it possible? Is it plausible? Is it probable? To make sure I'm not telling a fairy tale. So that's where we are, is I feel that I have a possible, plausible, even a probable story. The next step is where you really get into the mechanics of valuation. I've got to take my story and convert to numbers. Let me explain what I mean by this. Essentially, every word in my story is going to come back into my numbers. I described Uber as an urban car service company, so the total market that I looked at was the urban car service market, which in June of 2014 was about $100 billion. Then I looked at the fact that it was attracting new users into the market. And the way I showed this is by giving the car service market a 6% growth rate rather than the 2% the growth that they had before. But remember, I also said Uber has local networking benefits. You're saying, what does it even mean? In my world, you can have a dozen different ride-sharing companies dominating different parts of the world. So in my world, when I look at the market share I would give Uber, I can't give them a 30, 40, or 50% market share because there are too many players. I gave them a 10% market share, huge by car service standards in 2014, because if you think about it, car service then was dominated by cab companies, And nobody had more than 0.1% of the market, so I'm giving them 10%. I did assume they can keep the 20% fair, which is pure gravy because they're doing nothing for it other than connecting customers. And if they can keep doing that, that's going to translate into immense profit margins, 40% margins. And finally, I also assume they don't buy the cars and they don't hire the drivers. You're saying, where is that going to show up? It's going to allow them to grow very easily without investing. And the way that I showed that is by giving them a sales to capital ratio of 5. You're saying, what does that measure? For every dollar of capital, I'm assuming they can get $5 of revenue. To give you some perspective, the average for all U.S. companies is about 2. Across manufacturing companies, it's like 1.25. Even across technology companies, it's 2.5 to 3. I'm giving them $5 of revenues for every dollar of capital. Why? Because they don't own the cars, they don't hire the drivers. Every part of my story has become a number in my valuation. To round out my valuation, I need a discount rate. How do we do it for regular companies? We went through a contorted exercise of estimating betas and risk premiums and risk-free rates and cost of debt and debt ratios. I spent about 2 minutes on cost of capital for Uber. Why? Because this is not what's going to make or break my valuation. I gave them a 12% cost of capital. Why 12? I actually have a histogram of cost of capital across all companies. You can see that in my blog. It's at the start of every year. I do this histogram. You know what a histogram is? I look at the 10th percentile, the 20th percentile. So basically, I look across all companies. The median cost of capital for a global company was about 9%. For a U.S. company, it's about 8.5%. The 90th percentile of cost of capital for U.S. companies was about 12% in 2014. So what am I saying? They're a risky company. I'm not going to do dances around you claiming to know what their beta is. I'm just going to give them a high cost of capital because this is not where I want to spend my energy. So I gave them a 12% cost of capital, at least to start the game. And finally, there's one last loose end I'm going to bring in. This is a young company losing money. In a discounted cash flow valuation, what do I assume? That I can fix them, right? Fix them in what sense? I can start making improve their margins, they become a healthy company, and that's not an unreasonable view, but is there a chance they might not make it, at least in the way they look? Yeah. And there is nothing you can do in a discounted cash flow model to bring that in. You can't increase the discount rate. Discount rates were not designed for that kind of risk. So I bring it in explicitly as a chance of failure. There's a 10% chance that Uber will not make it. Why so low? Because it was so big in terms of how much. See, this is one of the ironies with if you're a young, small company and you're really small and you're on the verge of failure, nobody cares. If you're a young, big company on the verge of failure, people are afraid to let you fail because they have too much money at play. So venture capitalists will actually throw good money after bad money to make sure you don't go away. So in a strange way, that's helping Uber because it has a $17 billion pricing. I put in a 10% chance they will not make it. Yes? In a sense, it's, if you look at the percentages, 2/3 of all young companies fail. So you can actually see it. And as companies age and become bigger, you actually see the failure rate drop off. So I was just drawing on the statistics, and it drops off very quickly. Your mortality as a young company is greatest in that first year. You run out of cash, nobody comes with extra cash, you're done. So as you survive a year and you get larger, your chances start to improve fairly dramatically. So the 10% is, in a sense, about the floor you can get for a company that has failure rates, because once you get below 10%, you might as well completely ignore it. Would you separate that out by industry? You could. It varies by industry. It depends on how it really, you know what it depends on? It depends on how dependent you are on external capital to keep going. If you're a company that can survive with internal capital, you're less likely to fail, because the way young companies fail is not because they borrowed money and they can't make interest payments, they just run out of cash. Seriously, they run out of cash. Their checking account runs to zero. They can't pay their employees, and they say, go home, guys, the game is over. So running out of cash is your biggest problem. You run out of cash, A, because you're dependent on others, and B, because if the venture capital market dries up. So that's the macro variable that you worry about, is everything can go fine. The venture capital market is booming and everybody's optimistic. You can keep raising more money. But if that dries up, all of a sudden everybody runs into a cash crunch. So those were my inputs. I've converted every part of my story into value. Once I do that, the valuation kind of does itself, right? Because I've got a revenue growth, the target. If you've taken my Excel spreadsheet, the simple Ginzu spreadsheet, there are 3 variables I ask you for in your company. What's your revenue growth? What's your margin? What's your sales to capital ratio? The revenue growth captures the growth part of your story. The margin captures the competitive advantages part of your story. The sales to capital ratio captures your capital intensity part of your story. I've got them all. And my cost of capital just reflects the riskiness of the company. The valuation kind of does itself. So it looks like an Excel spreadsheet, right? But if you point to any number on that spreadsheet and ask me why is that number what it is, my answer is going to be a story. So you ask me why are my revenues $3.6 billion in year 10, I'm going to say because I think Uber is an urban car service company with local networking benefits. Why are my margins so high? Because it gets to keep 20% of share of the fare for doing nothing. Why is my reinvestment so low? Because they don't own the cars, they don't hire the drivers. When I talk about valuation being a bridge between stories and numbers, that's what I mean. Is when I point to a number and say, why is that number what it is? I want a story, an explanation built on the company. So I finished this on June 8th of 2014. I posted this on my blog like 3:15 in the afternoon, and based on my story, the value that I get for Uber is $6 billion. I know it's been a while, but do you remember the original Wall Street Journal story that drew my attention to Uber? What the number was in that story that made me curious about Uber? It was $17 billion. So I finished and post this on. 3:15, 3:25, I get a call from a Wall Street Journal reporter. She must have been just waiting at her desk for my blog post to come out. She said, I noticed you just posted a valuation of Uber. I said, thank you for noticing. She said, I also noticed your value is only $6 billion. I said, you're very observant. She said, you do know that venture capitalists have valued the company at $17 billion. I almost corrected her on the spot then. By doing what? That they don't value. But she's a journalist, I cut her some slack. They don't know the difference in value and price. I said, okay. I said, yes, I do. And she said, how do you explain the $17 billion? I said, I don't have to. I didn't pay it. I've never felt the urge to go around explaining what other people pay. What business is it of mine? And that's something I bring because I get called all the time and asked, how do you explain Bitcoin at 3,500? Why the hell are you asking me? I didn't pay 3,500 for Bitcoin. Why is Uber going to be worth 125 billion? I'm not paying it. Don't ask me. So I said, no, it's not, no, I didn't pay it. Don't ask me. You should ask somebody who paid the 17 billion. You're saying, are you telling me they're wrong? I said, no, I'm telling you nothing of the sort. I'm saying with my story, I would not invest in Uber. But I'm not going to tell you you can't invest in Uber. Maybe you have a bigger story. And that's the way I think about investing. I don't own the story on Lyft or Levi Strauss or Pinterest or whoever I decide to look at next. I have a story and a value. I'm going to base my investment decisions on my story. But if you come to me and say, should I invest based on a story? You know what my answer to you is going to be? Don't. And that's why I leave the spreadsheet open. I want you to disagree with me and come up with your own story. This is your money. And we need to take ownership of our decisions, which means we need to own the stories we're investing in. So don't listen to CNN. I don't care who it is on CNBC. It could be Warren Buffett talking about a stock. You invest in a company, it cannot be based on Warren Buffett's story in the company. It's got to be your story. You might agree with the story and decide to use it, but make it yours. So that was my June 2014 Uber valuation. So at this stage, I've told a story about a company, I've converted the story into numbers, and I've converted the numbers in valuation, and my hope is that each of you will get there by Friday. And when you're done with the evaluation and you send it in to me or show it to somebody else, what would you like to hear? Amazing. This is exactly how I value a company too, right? And here's my advice to you. Don't hang out with people who agree with you all the time. In fact, don't hang out with anybody in this class because they will all say this is exactly the way we should all be valuing companies. The last step in this process is what I call keeping the feedback loop open. And it requires you to do something that's going to make you uncomfortable. It requires you to go to people who think least like you. In fact, get into an Uber car, show it to the driver if you're valuing Uber. So what do you think about this valuation? He's going to rip it apart. He has no idea what a cost of capital is. What is cost of capital stuff? I have no idea. Then you're going to have to find yourself explaining what a cost of capital is. And it's an incredibly sobering experience because you realize you're using things all the time and you can't. My test is very simple. If you have to sit next to your aunt at Thanksgiving and she says, can you explain this valuation you've done? And you have 5 minutes to do it. Can you do it? Because if you cannot do it, then in a sense you got to wrestle through ways of explaining things. Seek out people who think least like you and be ready to duck because they will throw things at you. Not physically, hopefully, but metaphorically. Oh, what's this? Where did you do that? And keep yourself open to the possibility that your story is wrong, that you want to change it. I got incredibly lucky on my Uber story. It got picked up in 4 very different places. The first site it got picked up was a site called 538.com. Have you heard of this site? It's run by a guy called Nate Silver, who used to work for the New York Times. He's a statistics geek. In fact, if you like statistics and property, it's an amazing site because they take statistics, they apply it to politics, to sports. Is it true? In basketball, have you heard the legend of the hot hand? You hear all this myth, right? You have a hot hand. Everything you shoot will go in. So they ask the question, is there in fact a hot hand? So they all open they don't start out with a point of view. They say, let's look at the numbers. Is it true that when Stephen Curry has a hot hand, then every 3-point shot he tries falls in? So they said, we like this because it's the way our readers think. So they took my entire blog post and valuation, ran it on 538. The second place it got picked up was the Forbes blog. Who reads the Forbes blog? Probably 75-year-olds with flip phones. Really old investors, old-time investors who believe in dividends. That think of them as the Ben Graham security analysis crowd, who believes the whole world has gone to hell in a handbasket. You're paying 20 times earnings. What's wrong with you? You base your investment on cash flows. What's wrong with you? You just want to go with dividends. So they said, we'd like to run it too because nobody values these companies. The third place it got picked up was TechCrunch. You heard of TechCrunch? It's a Silicon Valley digital magazine. It's run by VCs and geeks. And the fourth place it got picked up was a ride-sharing guy. Have you ever heard of this guy? He's actually live. It's a blog written by a guy for just Uber and Lyft drivers. You think, how many of them can there be? You know how many Uber drivers there are in the world? 3 million drivers. 3 million people drive for Uber. So he has a big audience, same blog post, same valuation, 4 different sites. I get 4 different sets of reactions. On the 538 site, I get questions like, I noticed you used a 12% cost of capital, but your 90th percentile was 11.97%. Why did you not use 11.97%? This is how numbers geeks think. So my response was, why don't you take the spreadsheet, change the 12 to 11.97%, see what happens. 5 minutes later, I get an email back saying, nothing happened. I see why. Okay. There's nothing I was going to learn by second decimal point questions. I kind of let that go. Then I get to the Forbes blog. They loved what I did. They said, those tech guys, this is the way you should be valuing companies. I didn't even waste my time on that site. And then I went to the TechCrunch guys. And they absolutely hated it. Their reaction was, how dare you value one of ours with your DCF model? We don't do that in Silicon Valley. Get out of here. There were 4,000 comments on the TechCrunch article. 2,000 were pure insults, most of which went over my head. They called me a New York, you New Yorker. That's an insult, I guess, in some parts of the world. You DCF guy, I don't even know what that means. Is that a good thing, is that a bad thing? You academic, you theorist, et cetera, et cetera, et cetera. So half you could just abandon, there's nothing you could learn. But the other half started with an insult. You idiot, let me tell you how ride sharing works. And you know what? I'm not a ride sharing person. I don't know how the technology works. And if I was willing to get past those first 2 sentences of insults, I learned something about the business, about how Uber collects data, how they set surge pricing, how they learn things about you that can help them sell you more services. Keeping the feedback loop open often means not getting defensive. Because your first reaction, and this is human, when somebody says you're wrong or you're an idiot, your reaction is, I'm not an idiot, let me show you, how not idiot I am, by just ignoring you completely, right? And finally, on the ride-sharing guys, I heard from Uber and Lyft drivers around the world. And I heard some very interesting things about this business that I would never have heard if I visited Uber headquarters. I heard from a driver, an Uber driver in LA, and he said, I read your post on Uber. And I know they tell investors they keep 20% of the fare, but it's a lie. Because here's what they're doing in LA. They paid me $2,500 to switch from Lyft. Now Lyft is offering me $3,000 to switch back. And my guess is they'll offer me $4,000 to switch back to them. By the time they do all of this, I'd be surprised, he said, if they kept more than 7 or 8% of the fare. And you know what? 3 years later, Uber leaks out another number. It says their contribution margin in their biggest cities, you know what a contribution margin is, what they keep of the fare, is closer to 7 to 8% than 20%. Well, I knew that 3 years ago because I talked to an Uber driver in LA. I have never talked to the top management of a company when I value a company. For 2 reasons. One is, what you hear is PR crap. They'll do a strategic dance around you, and after you're done, you have no idea what they've actually said. The second is you are now beholden to the top management, right? They think they've given you information, so you have to send your valuation to them, and they reserve the right to say you can't do that, you can't do that. I don't want to be there. I want to be able to say what's on my mind no matter what. So I got 4 different sets of feedback. And it all came to fruition for me when I was sitting at Munich airport waiting for a connecting flight. I don't even know where, probably back home. And my flight was delayed. So I started checking my emails. And I get an email from a guy called Bill Gurley. For those of you who don't know who Bill is a partner at a venture capital firm called Benchmark Capital. Benchmark was one of the earliest VCs to invest in Uber. They invested in Uber at $1 billion. Bill served on the board of directors of Uber in 2014. He was at least rumored to be the person closest to Travis Kalanick, the CEO of Uber. So let me ask you a very easy question to answer. Do you think Bill Gurley knows more about Uber than I do? Of course. So I opened the email. And here's how it begins. It said, I read your blog post on Uber and I did not like it. I said, okay, we got that out of the way. It said, I've written my own blog post to counter your blog post to blog post warfare, very high tech. I've said some mean things about you. I just want to let you know. Sincerely, Bill. I close the email. I have an hour and a half left for my flight. Guess where I go next? I go to his blog. It's called Above the Crowd. Lead article on Above the Crowd. It says, Demodrin misses by a mile. Get it? Uber driving GPS. Basically, my GPS was screwed up. I'm going all over in the wrong place. And he took issue with every part of my story. He said, Uber is not a car service company. It's a logistics company. Notice how words have consequences? By using the word logistics, what's he just done? He's expanded his business from car service to car service moving delivery. He said, we're not just urban, we're going to be everywhere. He gave examples of suburban and rural services that Uber was planning to offer. And he said, we're finding ways to take our dominance in big cities and make them dominance globally. He gave the example of how they were working with United, where when you made a reservation to fly from Newark to Jakarta on United, right after you checked off that box that said, I don't want to be dragged off the plane, which is an option, I guess, on United, you put another box that said, I want an Uber waiting for me in Jakarta when I get. So basically, it was an interesting story of how they were going to take dominance in some cities and make it dominance in others. It was a global networking story. I was fascinated. Along the way, he took a few swipes at me, but I really didn't care because I was reading a big story. So after I was done, I emailed him and said, Bill, I read your blog post and I really liked it. Would you like me to put a number on your story? He said, what are you talking about? I said, you're telling a really big story about Uber. I can convert into a number. He said, be my guest. So I went in and changed 2 numbers in my valuation. Remember that $100 billion total market I went after, which is the car service market? I tripled it. Why? Because that's what moving and delivery does. It makes your market much bigger. Remember that 10% market share I gave them because I had local networking benefits? I said, if I buy into your story, you could very quickly become a global networking benefit. That gives you a 40. With those 2 changes put in, the value that I got for Uber was $53 billion. I sent him the valuation. I said, do you like this more? He said, a lot. He said, oh, by the way, just between you and I, which is something nobody should ever tell to me because nothing you tell me is ever going to stay with me because I'm going to write about it in my next blog post. Right? So he said, just between you and I should tell you that this 80-20 mix is not really, we get to keep closer to 10%. I almost told him I knew that already because I talked to the Uber driver in LA and he let this out. I said, that's not a problem. In my spreadsheet, that's an input, the 80-20. I made it 90-10, and that translates to lower margins. The value that I get is $29 billion. You see, how can the same company be worth 6, 29, 53? In fact, when I wrote this blog post, the conclusion people draw was, hey, see, I told you so. You can make a DCF value give you any number. That's not what I get out of this. The way you frame your story can give you very different numbers. Doesn't mean they're all equally probable, right? So one of these stories is going to be closer to the truth than the others. But the way, if you're a founder, you start a business, the words you use to describe your business can make the difference between whether you're $1 million business, 100 million, or $1 billion, right? If you read the Lyft prospectus, notice they never use the word car service. It's transportation. They want you to think about the car market, which is a $2 trillion market, because they want you to think big, because then a small percentage. So you have to also be aware of that. So you can't let them tell the story. You have to frame the story in your terms. So this was in probably July of 2014, a month after my original one. I knew in September of 2014 that I'd got my story wrong. You know how I knew? My youngest son then was about probably 12, 13. And he had a friend over. And this is in the middle of the suburbs. So when you have a friend over, at 6 o'clock, it's time for the friend to go home. And usually it's a mom car that comes by to pick up I'm not being sexist, the mom car, the dad car has to come in. So I'm waiting and a car pulls up into the driveway and it's a strange car. And I turn to the kid and say, what's that car doing here? He said, it's an Uber. I was going to say when a mother or father takes the most prized possession, but I don't know where this kid stands in the hierarchy of possessions. When you're deciding an Uber can take them home, I mean, in a sense, that's telling you something about a car. You would never send a cab to do this. And I knew I truly messed up when in October of 2014, I went back home to Chennai, which is where I grew up. I visited my parents who are elderly and lived there. My mother, who's mid-75, 76, conservative South Indian. And if you know India, conservative South Indian is about as conservative as you can get. It's almost like you're 600 years in the past. Everything is a huge shift, right? Going to a restaurant was big. We have a cook at home. Why would you ever go to a restaurant? Who does that? Yeah. So we have to go somewhere, and she pulls out a smartphone. And I'm already surprised. She has a smartphone. And she hits the smartphone. And I said, what are you doing? She says, I'm calling an Uber. And I knew I'd completely got this market thing wrong. Right? So you get feedback in the strangest ways. And I'm getting feedback. In December of 2014, I decided on my blog to let people pick their own story for Uber. Have you ever been to a Build-A-Bear store in a mall? They're creepy little places. Basically, if you've ever been there, you go in with your 6-year-old, they give your 6-year-old a piece of skin to stuff. 30 minutes later, you got the ugliest looking bear ever created. But then they do something very sneaky. They come and say, you don't have to buy this bear, but if you do, it'll cost you $75. And you got your 6-year-old who created that ugly contraption next to you. There's no way you're leaving the store without the ugliest bear for which you paid $75. I created a build-your-own valuation of Uber. And here's how it worked. At each stage, I gave people choices. What do you think Uber is? A car service company, a logistics company, a transportation company, an on-demand company. What's an on-demand company? You want something in a hurry, the on-demand company will deliver it to you. Like what? You want pizza 15 minutes from now. You're too lazy to get off the couch. On-demand company, pizza is there. You want to see the Avengers, but you don't want to go stand in line. The on-demand company will go stand in line for you. You want to go to the bathroom, but you're too lazy to get off the couch. I don't think they can do it, but basically you get the picture, right? On-demand company. So at each stage I said, what do you think about Uber? What kind of company is it? What kind of networking benefits? Local, global, none. What kind of competitive benefits? And at the end of the process, I gave a range of values depending on the choices you made. So if you said, look, I think Uber is an urban car service company with no logistics benefits, it's worth less than $1 billion. Conversely, if you expand the market, you give it strong competitive advantages, it could be worth over $90 billion. Again, the lesson you should draw from this is not that any number goes, but that it's hubris to tell somebody that they're paying too much. It's not my business. I mean, I get, again, asked all the time, do you think there's a bubble in the tech market? I don't know and I don't care. As long as I didn't pay the price, what business is doing? Because the minute you say the word bubble, you cannot have a rational discussion anymore, right? Because what does bubble mean? You irrational, crazy guy. Then what is there to discuss? If we want this discussion process to be open, if we want the feedback loop to be open, we have to stop using loaded words along the way, because there can be no discussion once you throw those words in. So that's the process of valuing companies. And on Friday, hopefully, you will tell a story. You'll convert the story into inputs. You'll turn in a value. That's the good news. But here's the bad news. The world goes on. So you could have valued Boeing 4 weeks ago. You could have turned in your valuation thinking, this looks really good to me. And 4 weeks later, look at where we are, right? Stories can change. In fact, they can change in 3 different ways. They can break. What's a story break? You tell this great story about a company and it looks great until the whole story blows up. I'll give you an example. About 4 years ago, there's a company called Arrow. It was a small company that basically allowed people to watch cable channels on their smart devices without paying cable fees. That sounds too good to be true, right? They claimed to have found some loophole that allowed them to carry the cable channels. And of course, the cable companies disagreed violently. So they sued. The suit made its way all the way to the Supreme Court. At the time the court heard the case, Arrow was valued at about $2 billion. Because if this was really a way of, you're going to be able to get a lot of subscribers. The Supreme Court, I think in June of 2014, ruled that what Arrow was doing was illegal. The value of Arrow overnight went from $2 billion to 0. Here's another example. You decide to invest in the cheating business. It's a big business. A lot of cheaters. Ashley Madison. Looks like a good way to invest, right? So you invest in this is a true story. Ashley Madison Company. There was a company that allows, think of it as the Tinder version of, less, for people who should not be Tindering. Yeah. So this is a company that was, so in a sense, it's a company that, again, claimed to have found this pretty big niche market of cheaters. The pricing for the company went up to $2 billion, $2.5 billion. They found really creative ways to connect cheaters with each other. Until in early 2015, they had a bit of a problem. You know what the problem was? Somebody tapped into their computers and released the name of every cheater. This is not a great development, right? There are very few cheaters who like their names up in, like, this guy's the biggest cheater of them all. Maybe somebody says, I am the biggest cheater, and he thinks this is a bragging right. But there goes your business model. Overnight, the company's value went from $2 billion down to $500 million. Story break. Last week, Biogen had a story break. You know what happened to Biogen? They have an Alzheimer's drug, which is working its way through the pipeline, supposedly with a lot of promise. And Alzheimer's is a huge, huge market if you can figure it out. And last week, they announced they were pulling the drug late in the approval process because it just wasn't working. Biogen lost a quarter of their market value in 15 minutes after that announcement. And this is a big company. You're talking about $20 billion in market cap gone. Those are story breaks. Now the question with Boeing is the MAX a story break? What will make it a story break is if it's truly a problem that cannot be fixed. The MAX is the best-selling, the 737 MAX is the best-selling Boeing aircraft. If you take that out of the arsenal, it's not like you can overnight replace it with Dreamliners or something else. There's nothing there. It's going to knock a huge chunk of Boeing's value out. We don't know yet, but that remains a possibility. That's a story break. A story shift is your story is not changing, but the contours are shifting. I've described Apple as the greatest cash machine in history, but a mature company. For the last 7 years, I've told the same story about Apple. It's a mature company, the greatest cash machine. The way this manifests itself is you look at all my Apple valuations for the last 7 years, I never use a growth rate greater than 3 or 4% revenues. Even if they have a spike in the growth rate after a particular iPhone, I said, this too shall pass. For whatever reason, markets seem to overreact, but no. But the numbers I use shift because I learned things about Apple, about their capacity to keep competitors at bay, which can change the growth, but the basic story remains unchanged. And once in a while you can get story changes that can happen because a company shows me it can do something I did not think it could do. For me, Facebook, the value that I was stuck around was $30 to $35 for a long time until they made the breakthrough on mobile. I know most of you are probably too young, but when Facebook went public, the mobile version of Facebook was horrendously bad. It was unusable. In fact, they went public and people were convinced they would never figure this out, which, if they hadn't, would have been a catastrophe of the company, right? Because let's face it, most of us are on mobile most of the time. We're not on computers. But somewhere about 6 months or a year in, they figured it out. And they did a really good job. And when that happened, it shifted the story for Facebook. All of us, the original valuation of Facebook I gave was what I called them a Google wannabe, which is not a bad wannabe. But essentially I said they're going to look like Google as they grow. That shift to mobile put them on hyperspeed. It gave them a much faster acceleration. They've grown twice as fast as Google for the first few years of their existence. So those are story changes. Be open to those things happening to your stories. Hopefully you will not get a story break. But I can't guarantee it. The world has surprises to deliver. But story shifts can and will happen, which means the story you give me on Friday might not be the story you turn in the middle of May. Because I don't know what will happen between now and the middle of May. So story shifts, story breaks, and story changes. So that was a long lead-in. Let's now value companies. I haven't valued a single company yet other than Uber, right? So I'm going to take some valuations. Each one, I'm not going to get lost in the mechanics because by now you understand the mechanics. It's cash flows, growth, and risk. I'm going to use each valuation to illustrate a point about valuation. So I'm going to start with some basics so I don't come back to this. You're going to see valuation stretching from 2000 and probably earlier than that, 2003 to 2019 over the next couple of sessions. And the equity risk premium is going to be different in each of them. So I'm going to give you a preview of why. It's because my implied equity risk premiums changed. So pre-1998, I used to use a 5.5% risk premium. And it was pretty much stable because developed markets, I said, they don't change that much. Between 1998 and 2008, I ended up using a 4% premium. If you remember the implied premium graph for the S&P 500 leveled off around 4% after 9/11. Right? Then after 2008, I changed my mind. I said, this isn't working. I have to be much more flexible. So you're going to see risk premiums actually shift from month to month, depending on which month I did it in. So when you look at a valuation, look at the timing, and you're going to be able to explain why the premium looks low or high. And of course, the risk-free rate is also going to change. So here's the first thing I'm going to do. I'm going to start off with each company, telling you a story about the company and showing you the valuation, then use each valuation to illustrate a different aspect of something you might run into. So let me start really easy. I'm going to value Con Ed. It can't get any easier than this. It's like valuing a bond, right? It's a regulated utility that pays huge dividends. Right? So let's start by valuing a stock that looks like a bond. So this is a Con Ed valuation on August 12th of 2008. So it's a company that essentially pays out 73% of its earnings as dividends. Has very low growth. Why? Because it is a regulated utility serving a mature part of the U.S. It's not like the mountain states, so the population can grow. So it is. So my first question was, can I get away by just using a stable growth model? Right? To use a stable growth model, I need to make sure it behaves like a mature company. So here's what I did. I checked the numbers. I started by looking at the payout ratio of 73%. Does that look like a mature company payout ratio? Yeah, it's a very high. If I'd seen a 15% payout ratio, I'm going to be a little more uncomfortable. So 73% payout ratio. I looked to see whether the growth rate they had was like a stable growth rate. What's the stable growth rate? It's going to be less than or equal to the growth rate of the economy. If I take the retention ratio and return on equity, which is about 7.7%, they grow at about, so the growth rate I get is 2.1%. The payout ratio looks like that of a mature company. The growth rate looks like that of a mature company. My final stop was to check their cost of capital. If you're a mature company, your cost of capital should be roughly that of a mature, and it turns out that the cost of equity that I get for them is about 7.7%. So they've got a mature company's payout ratio, mature company's growth rate, a mature company's cost of equity. I just got lucky. Because of what's the value of equity for a mature company? I take the expected dividends next year, divided by the cost of equity minus the growth rate. The value per share I get is $42.30. The stock was trading at 47. So those of you who've been putting off your valuation, try it. Maybe you get lucky and you'll have a Con Ed. You'll be done in like 5 minutes. All you need is expected dividend next year, cost of equity minus growth rate. But before you do that, you've got to make the checks, right? Is it really? So don't take Google and put it into a stable growth dividend discount model and tell me the stock is worth nothing and ask me for feedback, because I'm not sure what kind of feedback I can give you. So this is a $42.30 value per share. The stock was trading at $40.76. I'm getting a value different from the price. And I'll wager that unless you're insanely lucky or you've been messing with the numbers, that you will get a value different from the price. So here's a simple what if to ask. What is the market assuming that so in other words, I could, the big number here, if you think about it, if the growth were lower, my value would be lower. I can calculate what that break-even growth rate has to be to justify the market price. So what I did actually was I kept everything else constant and changed just the growth rate. So think of it like computing an IRR. Instead of computing for an IRR, I'm computing for a break-even growth rate. Break-even rate, a growth rate that will deliver a value per share that is equal to the market price. You can do this with any kind of valuation. You can finish your valuation. Let's say you get a value of 34 and the stock is at 26. You can ask, what would the growth rate need to be? Because you used a growth rate that gave you 34. You can ask, what would the growth rate need to be to get to 26? There's a whole book on this called Expectations Investing by a guy called Mike Mabusson, a person I highly respect, where essentially he does this in companies. Instead of valuing the company and comparing the price, he says, let's solve for what the market is assuming. It just defers the choice you have to make, because after you've solved for the growth rate, what's the question you have to ask? I've used an 8% growth rate. The market seems to be using 6. Is that difference noise, or is that different enough that I feel willing to invest in the company? It's not that it's making your decision any easier, it's just making it a different way of framing your decision. It's a break-even growth rate. Incidentally, I use those dividends. One thing I forgot to mention there is I have to make sure the dividends that are being paid are roughly equal to the free cash flow to equity, right? The reason I can afford to use a dividend discount model for Con Ed is I actually computed the free cash flow to equity. This is one of those unusual companies that actually pays out almost all of its free cash flow to equity as dividends. So if I'd done a free cash flow to equity model, I'd have got exactly the same value. So that's the first stop, very simple company, but it's an easy way to kind of see why, if you get a value different from the price, you can solve for what that break-even has to be. Okay. So let's play a little game. Let's assume that you accept my valuation, 42 to 30, as a fair value for the stock. My cost of equity is 7.7%. Okay. My expected dividends next year are $2.32 growing at the 2%. So I've given you 3 pieces of information. I've given you my value per share, I've given you my expected dividend, I've given you my cost of equity. What's my expected? You know how equity research analysts give you target prices? Is there a way you can take a DCF value and make it a target? Because the DCF value is as of right now. But let's say you get a job as an equity research analyst. I'll wager your managing director is going to say, I don't care about your DCF stuff, I want a target price in a year. Is there a way you can take my DCF value and make it into target price with the information I've given you? When I say that the fair value is 42.30 and you pay 42.30, what are you going to make as a rate of return on the stock? You're going to make a fair rate of return, which is 7.7%. So if I take the 42.30 and grow it at 7.7%, that's going to give me the extra return, but some of that return comes in the form of dividends. So if I take 42.30, grow it at 7.7% and subtract out the dividend, I'll get a target price. If you really want to continue to do DCF valuation and you want to work in sell-side equity research, you got to figure out a way to bridge that divide between what DCF value does, which is value the stock today, and what equity research analyst requires, which is can you give me a target price 5 years from now? What would you need to do? It's actually very simple. Take it and compound it, right? Basically, if it's a 4%, because if the 7.7%, 2.5% comes from dividend yield and 5.2% comes from price appreciation, which is what I'm breaking down. I ask you, what's the price 5 years from now? So you can go crazy. You can say, you can tell your managing director, you want target price just for, I'll do it for the next 100 years. Because all you need is essentially an Excel spreadsheet. You can do target prices in year 2, year 3, year 4, year 5, because all you require is the value today and the growth rate. And in fact, given that the stock is trading at 40.76, your actual return is going to be that the 40.76 is going to adjust not just to the 42.30, but over the next year it's going to adjust to that higher number. So when I valued Kraft Heinz, I had valued it like 32, and I said 33, I'm sorry, more than that, 33 something. And I said I'd buy the stock if it dropped to 30. And one of the comments, if you look at the YouTube video, was, it was within like 6% of them. He said, why would you buy the stock if you're going to make only a 6% return over the next year? I'm not going to make a 6% return over the next year. I'm going to make 6% plus whatever my cost of equity is. So when you do discounted cash flow valuation, keep that in mind. When you find something is fairly valued and you buy it at that fair value, you're still making money. You will just make the cost of equity, which is not a bad return to make, but it's a rate of return that's embedded in the value. Any questions? Now let's take a second company. 3M. Do you know what 3M does? Lots of boring things that make it a ton of money. Like that incredible invention called the Post-it note. That guy deserves a Nobel Prize for something, I don't know what. But that must be genius, right? Put a little sticky thing on the back. So this was a valuation I did of 3M on September 12th of 2008. That date is significant. It was a Friday before the great collapse. That Friday, I don't know what I was doing. I valued 3M. I won't take you through the details, but I valued the story I told of 3M was it will continue to be a high margin, high profit business with reasonable growth. But partly because it's a big company, the market's fairly mature, 7.5% growth before it becomes a mature company. So you have the 7.5% growth, your margins get maintained. It's a status quo valuation, essentially. So I'm looking at the numbers and saying, this company looks really good. I'm going to build it in. The value that I got was $83.55. Discounting free cash flow to the firm at the cost of capital, adding cash. So basically, I followed every rule we've talked about, right? Stock was trading at 70. I was in a hurry to get home that day. I didn't get on my brokerage account, and thank God for that. Because if if you look at those values, what should I be doing? I should be buying, right? And I'll be honest, I wanted to buy, I just put it off until Monday. I said, what can happen over a weekend? Over the weekend, of course, you had the crisis. 1 month later, I revalued 3M. Nothing had changed about the company. There's no financials that had come about the company. No new income statements, no balance sheets. Now, there is this branch of intrinsic valuation that claims that intrinsic value is a stable number. It shouldn't change unless you get information about a company. It's an absolute lie. Nothing has changed about the company, but everything has changed in the market, right? In particular, what has changed? What does a crisis do? It pushes up the price of risk. It pushes down the risk-free rate. It changes the expected growth rate of the economy. How can your value not change when the world is not changing around you? So a month later, I revalued 3M. None of the underlying base numbers had changed. But here's what had changed. Because of the crisis, my risk premium, which was 4%, had jumped to 6%. That implied premium had risen. The default spread, even though the rating hadn't changed, the spread that went with that rating had almost doubled. A higher default spread and a higher rating translates into a 10.27% cost of capital instead of a 7.88%. And the value that I got was $60.53. That's a 25% drop in value, but that's what crises do. And the reason I did this is to illustrate the fact that if God, I hope this doesn't happen, but between now and May, if there's a market meltdown, you will have to revisit your valuations even if nothing in your company has changed. Because the implied equity risk premiums are going to change, the default spreads are going to change, and that's going to feed into a very different value for the company. So that's two companies I value. Can I value an entire index using an intrinsic valuation model? What's the value? When I say DCF model, DCF model says the value of an asset is the present value of the expected cash flows in the asset. That asset can be a company, it can be an individual asset, or it can be an entire index. So let's assume that I want to value the S&P 500 as an index. Let me start with a scary looking valuation. Let's try a dividend discount model on the S&P, because that's been around a long time. So in a dividend discount model, the value of the S&P 500 should be the present value of the expected dividends on the S&P 500. So this is in January 2015. The dividends in the trailing 12 months were $38.57. The growth rate that analysts were projecting was about 5.58%, so I projected the dividends for the next 5 years. Beyond the 5th year, I assumed mature growth, stable growth, because this is, after all, the S&P 500. You can't keep growing faster than the economy. Made that growth rate equal to the risk-free rate, 2.17%. So all I have are dividends growing at 5.58% for the next 5 years and 2.17%. I need a cost of equity for the entire index. And this is actually a relatively simple computation. Why? Because you have a risk-free rate and an equity risk premium. But the beta is 1, why it's the entire index. So I put in a beta 1. I get a cost of equity of 7.28%. I'm almost home. I discount the dividends back at the cost of equity. The value that I got at the start of 2015 for the index was $895. I told you it was going to be a scary looking valuation. The index is at 2059. If I believe this valuation, the index is not just overvalued. This is a huge bubble, right? But what am I missing in this valuation? What am I discounting? Dividends. And if you remember, one of the things I talked about is increasingly what are U.S. companies doing? Buying back shares. So one very simple fix here is say, look, you're looking at the wrong number. U.S. companies are not paying dividends, they're buying back shares. So what's a simple fix for that? Add in the buybacks. So if I bring in the buybacks and make the dividends plus the buybacks the base, and I assume that I want to earn a 5.11% risk premium, which is the average premium over the period, the value that I get for the index is 2,332. All of a sudden, the index has gone from being overvalued to undervalued. If this looks familiar, here I've assumed an equity risk premium based on the past, right? When I did my implied premium, what do? I do the same, it's the same picture, but basically I solve for the equity risk premium. So if you ask me, are stocks overvalued or undervalued, you know what you're asking me. What's the right equity risk premium? That's really what the question becomes. If you're a market timer, that's what you're trying to do, even though you might not claim that that's what you're trying to do. Started this month. Do you remember what the equity risk premium was? March 2019, at least my implied premium that I computed. I think it was 5.36%. I can't wait till April 1st because 3 things are going to get updated. One is the buybacks for the last quarter of 2018 are going to come in, so I can update that number. The second is the growth rates that analysts are projecting for both the US and global have been updated. Not by much because the big fall happened between November and January of last year, but they've dropped slightly. And third, the risk-free rate has dropped. For the same reason, the growth rate has dropped. It's going to be interesting. I don't know what I'm going to find, but it is going to be a number that's going to be different. So the implied premium, what you do is you take the index level as right and you solve. Here I'm saying maybe the stocks collectively are overpriced, underpriced. I'm going to set the equity risk premium, solve for it. In fact, my implied Excel equity risk premium spreadsheet has this as a front end where you can pick an equity risk premium and actually value the market for you. So if you want to value an entire market, with an intrinsic value model, you can, but just don't use dividends, because then you're going to find pretty much every market you look at around the world looks overvalued, because dividends are such a small piece of the actual cash flows. One point that people often take issue when I do my traditional valuation is I use a growth rate that equity research analysts are projecting. But since we're doing an intrinsic valuation, you might say, well, why are we trusting analysts to come up with a growth rate? They can make up stuff. Why don't we compute, remember how we computed an intrinsic growth rate, a fundamental growth rate? What do we do? How do we get a fundamental growth rate for a company? We're looking at equity earnings. We looked at retention ratios, return on equity, right? So if I took the retention ratio times return equity, the growth rate I get is about 2% rather than 5.58%. I get an index level now which is very close to the actual index. So this is almost a completely intrinsic valuation. I'm not looking at analysts, I'm just saying let the numbers fall where they might. So my point is DCF is a very flexible technique. You can value entire markets, you can do it entirely with intrinsic numbers. Just get comfortable making those adjustments, because you have to adapt, right? You've got to change the model to reflect what you're looking at. But you can value pretty much any piece of a market. One final point. I know one of the things that I find interesting is when a big event happens, people say, what will this mean for the market? Okay. So last year, towards the end of the year, you remember there was a big corporate tax code change. And of course, there's a lot of expert talk about, and often what the problem you get when experts talk about things like tax code changing is they fixate on a piece of it, either good or bad, depending on which side they want to come from. And they say, that's good, therefore. No. It's like the old tale about the 6 blind men who are visiting, who are allowed to feel an elephant, and then they're asked to describe what an elephant actually is. And the first blind guy felt just the tail and said, elephant's just like a snake, and the second guy feels the trunk. So basically, it's almost like these experts feel a part of the tax code, and they come up. So I find it best for my own purposes when this happens to take the effects and play it through the value of the index. So here, for instance, I have a pre-tax reform and post-tax reform numbers for the S&P 500. And what I did was I made the changes to the post-tax reform numbers. So the post-tax reform effect is going to show up in multiple places. First is the marginal tax rate is going to drop across all companies from 35 to 21%. Second, that's going to translate into a lower effective tax rate because there are some companies that are going to be paying less. Third, that tax effect is not just going to be in the cash flows, it's now going to make your debt more expensive. Do you see why? Because previously you were multiplying by 1 minus 0.35, so your cost to cap. So the net effect here is your cash flows are going to be higher because you're paying lower tax rates. Your cost to capital is going to be higher because debt is no longer as attractive as it's going to be. But because I'm not just telling fuzzy stories, I can actually work out the numbers, I can translate what that means in terms of value. And just looking at the net effect of both of those, my estimate for how much the value of stocks collectively will change was they will change by about 9.7%. The positives outweigh the negatives if you bring in both sides of the equation. So my suggestion is there will be other big changes you run into. The day Brexit, whatever happens to it, on April 12th, the deadline keeps shifting. I have no idea what that day is. The day after it happens, turn off the news. Don't read the experts. Take the FTSE and work through what you think this means in terms of fundamentals, in terms of interest rates, in terms of risk premiums, in terms of cash flows. That's the way you wrestle with big issues, because if you take a piece of it and you make that the center of your focus, you lose sight of the bigger picture. Okay, so now we're entering into what I think is the most fun part of valuation. I know it sounds sick. If all you valued were nice, mature, money-making companies, you know how long this class would need to last? 2 minutes. And I'm not even sure I need you anymore. Because value a nice money-making company, what do I need? I need to project out the numbers. I just need a time series model. I can model valuation. I can probably automate the whole thing, fire you all and outsource you to a computer. So thank God for small blessings that there are interesting companies. So what I want to talk about is what I call the dark side of valuation. And I'll give you some history into how I came up with that name, because of all the names for my books, this is the one that I like the most, The Dark Side of Valuation. I actually wanted to put Darth Vader on the cover, but Disney said, no, you can't do that with a sword and all the rest. But let me give you a sense of why I call this the dark side of valuation. To value a company, remember there are 4 questions I said we need to answer. This is way back in time, at the start of the class. I said you need to tell me what are the cash flows from existing assets. Then I said, what's the value added or destroyed by growth? You have to look at the growth rate and the reinvestment. Third, I said, how risky is your company? So capturing the discount rate. So when will your company be a mature company? So let me start by stating the obvious. When those 4 questions are easy to answer, valuation is going to be easy. When those 4 questions become more difficult to answer, valuation is more difficult. That's the easy part of it. So let's think about when it is easy to value a company. If I gave you a stable money-making company and ask you, what are your cash flows from existing assets? You just show me your financials. Look, that's how much I made. When I ask you, what's the value of growth? You have a history of returns on capital. And so you can say, look, this company's made excess returns. When I ask you, what's your cost of capital? You can tell me the business is there. You can look at the beta, the debt ratio, the cost of debt. You have incredible inputs. When I ask you, when will you be a mature company? You can look at the history of this company. Say it's been moving. It'll be in 7 years. No wonder it's easy to value money-making, stable companies. When will it be difficult to answer these questions? First is if I give you a young company, especially if it's a startup, it's just been around, or even a company like Lyft or Pinterest. Think about answering those questions. Everything gets more difficult. When I give you companies that don't fit the accounting mold, because remember, many of these numbers, you're trusting accountants on invested capital, return on capital. So if you have a company where accountants are not doing the right thing, they're expensing capital expenses or capitalizing operating expenses, you're going to get strange numbers. Or if you have companies which have significant truncation risk. Discounted cash flow valuation was designed for going concerns. So if I give you a distressed company, discounted cash flow valuation will probably overvalue the company simply because you can't factor in the likelihood. If I give you a Venezuelan company, we're worried about nationalization, you're not going to be able to capture that risk in a DCF. So anytime you have discrete truncation risks, you're not going to be able to capture it with a DCF. So let's start by, I'm going to give you a list of the kinds of companies I'm going to look at over this session and the next one. I'm going to start off with young growth firms. I love valuing young growth firms. I find them challenging, I find them interesting, but they will make you uncomfortable, and you're going to see why. Then I'm going to move to mature companies. And normally mature companies are easy to value until they're not. You think what can make them difficult? Is they get to a point in their lives where they have to change. Look at GE. GE is a mature company. It's not easy to value. Look at Kraft Heinz. It's a mature company, but change is coming. And finally, I want to talk about declining companies, which are supremely depressing to value. Hey. Anybody here valuing JCPenney? It is going to make you very depressed. Get a lot of uppers, do whatever you need to do. You got to have mood uplifting things before you sit down to do that Excel spreadsheet, because by the time you're done, you're going to be drained. Because the end is near. And you don't know how to deal with this, right? It's a psychological problem. It's not, we know that the end, but it's very difficult to actually build into numbers. Then I want to talk about across markets, emerging market companies, what makes them difficult to value, the corporate governance issues, the emerging market risk. Then I want to talk across sectors, starting with financial service firms. I'm going to say something very weird, but I'll back it up. I used to think banks were the easiest of all companies to value. I no longer do, and I'll explain why. I want to talk about commodity and cyclical companies, why valuation is difficult when the numbers go, even mature commodity companies. Exxon is the most mature oil company you can think of. Its earnings go up and down, up and down. Why? Because oil prices go up and down, learning to deal with that. And finally, I want to talk about companies like Amgen, like Biogen, where the biggest value is coming from patents and physical assets you cannot see. So let's start with young companies. Let's say you are an entrepreneur. You have a young startup, and I'm going to try to value. And I'm going to come to you with my 4 questions, and you're going to very quickly see why valuing young companies is so difficult. You ready? You're the entrepreneur. You've just started the business. I ask you, what are your cash flows from existing assets? What's your answer? What existing assets? I don't even own the chair I sit in, so that was easy. Get that out of the way. Then I ask you, what's your value from future growth? You say a lot. You be more specific. You don't even have a business model, right? You can't. So you have to leave it at a lot. Say, how risky are you? Very. There's no history. There's no beta that I can look up for you. There's no default spread. There's no bond rating. And I ask you, when will you be a mature company? You fall out of the chair laughing. You don't even know whether you'll make it through this evening. Now do you see why most people don't even try to value young companies? Because the models and techniques we develop are for mature money-making companies, and if I try to blindly apply them to you, I'm going to run into trouble. So I'm going to use a company to illustrate this process. Right? And in fact, I'm going to up the ante here. Not only are young companies difficult to value, they become doubly difficult when they're in a sector where everybody else is also young. And here's why. When you think about valuing a company and the company you're valuing, think about where you got the information for your valuation. What's the first place you went when you went to sit down? Let's assume you're actually valuing your company. What's the first place you went to get? You start with the current financials, right? Then you looked at historical numbers for the company. And then you looked at the peer group to get a sense of what are margins like, what happens to company. One by one, let me knock your crutches out. Let's say it's a young company. What do you not have? You don't have much history. Yeah, it's a young company early in the life cycle. You might have the current financials, but there's very little you learn there. But if every company in your sector looks just like your company, you're completely and totally screwed because you have no financials, no history, and no comparables. This is when the dark side will beckon. Say, come on over. And says things like, oh, those old business rules don't apply to you. You don't have to make money. Users are good. There's been a paradigm shift, which means I have no idea what's going on. But it sounds so much better when I call it a paradigm shift. And I keep telling you macro stories. Why should I invest in artificial intelligence? Because it is the future. Who wants to contest the future? Why should I invest in this company? Because it's China. Why should I invest in social media? Because my daughter's on Facebook 16 hours a day. You have absolutely no idea what's that got to do with why I should pay X billion dollars for Pinterest. But you hear a lot of macro storytelling. You see metrics you've never seen before. This company looks cheap. You're paying only $80 a user. I remember these are not hypotheticals. In the late 90s, this was the dot-com sector, right? Every company was a young money-losing company. Then 10 years ago, it was the social media sector. Today, it's the cannabis sector. It's the artificial intelligence sector. And you see the same thing play out. Ask anybody why you should invest in Canopy Growth. One of the big, you know what the answer is? Because everybody's going to be smoking marijuana all over the place every day. It is the future. How do you argue? The guy you're arguing with is already smoking marijuana, so you're not even sure. No. It's almost impossible to permeate that, but that is the dark side. So in the late 90s, I'd be doing these sessions on valuation. I'd do them around the world. And during the course of the session, somebody would come up to me and say, you really cannot value Amazon.com using a discounted cash flow model, can you? And they'd have their finger going like this. And say, step back, you're going to hurt me. And at the risk of grave personal injury, I'd say, yes, you can value Amazon using a discounted cash flow model. And they'd give me this look of total contempt. Say, academic. And that's not a compliment. It basically means you can talk, but you can never value. And after the sixth time of being called an academic, I got really pissed off. So in 1998, for the very first time, I sat down and I valued Amazon. And I kept a journal of every roadblock I ran into in valuing Amazon, because what I brought into the valuation of Amazon is what I knew about valuation, which is what I'd learned by looking at what other people had said about, which was mostly built around big money-making companies. So I found that the things I had learned about how to compute growth, return on capital, doesn't work for Amazon. So I kept a journal of every roadblock and how I got around the roadblock. And to show you how many roadblocks I ran into, by the time I was done with my valuation of Amazon, my journal was 75 pages long, and I never waste anything I write. So I put a title on the journal, and I put it on my website. I called it The Dark Side of Valuation, Can Amazon.com Be Valued? That was in 1998. I tell people everything I know about valuing young companies, I learned in the process of valuing Amazon. Remember I described valuation as a craft? There's no, so if I'd gone looking, I don't even know what that was, I don't even want to look back. If I'd gone looking for what other people, there was nothing there. So what I'm saying is if you run into a roadblock, work it through, because Google search doesn't have an answer for you. I know it looks alluring. Let me go to Google search and type in, how do I value the company? You get a bunch of searches, some of them will be mine, none of them will be useful for you, so I'll save you the trouble. Just value the damn company. If you run into a roadblock, figure something out, keep moving. So I'm going to take you back to January 2000 to evaluate. This was my third valuation of Amazon. It was actually a valuation I did for the CFA. It was one of the very first live webcasts that CFA carried. It's still on their website. I think I've seen it. It was called No Earnings, No History, No Comparables, No Problem. They wanted a nice, sexy title. I said, you can use that. Can Amazon.com be valued? I won't go through the details because there are a lot of details. But I want to set the valuation up before we start next session. January 2000 was the peak of the dot-com boom. Amazon.com was the place to be if you're a portfolio manager. So I want to set that up because when I show you my valuation, in hindsight, you can say, that sounds incredibly optimistic. But at the time, I was accused of being really pessimistic. Just to set up the problem, at the time that I valued Amazon, it came into the valuation with revenues of $1.1 billion, which for a US retailer are tiny revenues, and operating losses of $410 million. Small revenues, big losses. So I'm going to leave you, and this is going to be the final piece for today. Can a company with small revenues and big operating losses become a valuable company? Yes, right, every company at some point. So help me out, this is pure mechanics. So what's got to happen to the small revenues? They've got to become big revenues. What's got to happen to the losses? They have to become profits. This sounds incredibly simplistic, but the first two inputs I will need to value Amazon is a revenue growth number, which will make my small revenues into big revenues, and a target operating margin. Now do you see where my spreadsheets of today were born? A target operating margin. But I'm being realistic. I'm not expecting Amazon to make this margin next year, but over time, as it matures, this is the margin I expect them to aspire to. And there's one final loose end. To make small revenues into big revenues, you need to reinvest. Okay? It's not going to happen by magic. So the third question I'm going to ask you is, how much will you need to reinvest to make your small revenues into big revenues? And this is where I got stuck the longest on my Amazon valuation. Not even know where they get, let's assume the capital markets are open and you can go raise it. How do I estimate what the reinvestment is? I tried everything I knew. I tried to take last year's capex and depreciation and forecast out. Didn't work because there was not much there. I tried to do the return on capital times reinvestment rate, but it didn't work. Why? What's the return on cap for Amazon in 2000? It's a big negative number. What's the reinvestment rate? A big negative number. You're saying this is very convenient. Big negative times big negative is big positive. But you put a positive growth rate and a loss, the loss is going to get bigger. It took me about a week before I found the variable, and you still see it in my spreadsheets. What's the only number of substance that's always positive on the spreadsheet? The revenue number. So I said, I've got to tie my reinvestment to revenues because everything else is shifting. My margins are changing, my operating income is changing. So I said, if I can somehow figure out how much I will need to reinvest based on what my revenues are, then I'm going to be home free. Hence was born the sales to invested capital ratio, because what that ratio measures is for every dollar of capital, how much do I get in revenues? So on Wednesday when we start, you're going to see those three numbers drive the valuation, but they're the three numbers that are still in my spreadsheet. They actually drive it for every company. For a young company, they're absolutely critical. Okay? So I will see you on Wednesday, and if you get done with your DCF, please send it in to me. Yeah, not the simple Ginzo, but the full Ginzo.